Today, I'm focusing on reading a cash flow statement, a core financial skill for every entrepreneur. It helps me see where money comes from, where it goes, and whether the business is generating enough cash to operate successfully. Cash flow is what keeps a business alive. By understanding these movements, I can make more informed decisions about spending, planning, and growth. This perspective is essential when developing a business plan because it connects financial goals with the practical reality of staying solvent and moving forward. Profit may look reassuring on paper, but cash is what keeps the business alive. A company can report a profit on its income statement and still run out of money, especially when customer payments arrive later than expenses are due. The cash flow statement provides the unfiltered view. It tracks the money actually moving in and out, exposes timing gaps between revenue and collections, and shows whether day-to-day operations can sustain themselves. That makes cash flow essential for understanding liquidity and spotting problems before they become crises. A cash flow statement is organized around 3 activities, and each one answers a different question about how cash moves through the business. Operating activities show whether everyday business operations are generating or using cash. Investing activities capture cash spent on or received from long-term assets, such as purchases and sales. Financing activities explain changes related to debt, equity, and dividends. Together, these sections provide a clear view of where cash came from, where it went, and how the company's financial activities are shaping its cash position. This section focuses on operating activities, meaning the cash created or consumed by the company's day-to-day business. It's often the clearest indicator whether the core operation is financially healthy, because it shows whether the business can support itself through normal activity. Consistently positive operating cash flow is the gold standard. It means a company is generating enough cash to keep running. By contrast, negative operating cash flow means reserves are being used to cover basic operations, which should be treated as a serious warning sign. This section focuses on investing activities, which capture how a business uses money to build its future. Common examples include purchasing equipment, property, or vehicles, acquiring another business or intellectual property, and buying or selling investment securities. Proceeds from selling long-term assets are included as well. Investing outflows are often a sign of strategic expansion, not distress. In a growing business, substantial spending in this category may reflect investments designed to increase capacity, strengthen capabilities, or support long-term growth. This section focuses on financing activities, or how a business raises and repays the capital that supports its operations and growth. The key idea is that financing cash flows show where funding comes from and where it goes. Inflows can include bank loans, investor equity, and bond issuance. Outflows include repaying loans, distributing dividends, and buying back stock. Together, these movements reveal how the company is building its financial foundation, managing obligations, and returning capital to shareholders. They complement, but do not replace, cash generated by day-to-day operations. There are 2 ways to present cash flows from operating activities. The direct method shows actual cash receipts and payments line by line, making it more transparent, but also more time-consuming to prepare. Because of that, it's rarely used in practice. The indirect method is the standard approach in most financial reports. It starts with net income, then adjusts for non-cash items, such as depreciation and changes in working capital. This is the method you're most likely to encounter in real-world business plans and financial analysis. This sample statement shows how individual line items combine to explain the movement in cash. Net income is $45,000, and depreciation adds back $8,000 because it is non-cash. The $12,000 increase in accounts receivable reduces available cash, leaving $41,000 in net cash from operations. From there, the business invests $30,000 in equipment, signaling growth, while $20,000 in loan proceeds provides financing. After those activities, the net change in cash is $31,000, a strong overall result. The key is to read each number for its cash impact, not just its label. This slide highlights several warning signs that deserve immediate attention. Negative operating cash flow means a core business is consuming cash, while cash below operating net income may indicate that reported profits are not converting into usable funds. Persistent reliance on financing is another concern, because the business may be depending on outside capital to sustain normal operations. The key metric here is the operating cash flow ratio, operating cash flow divided by current liabilities. A ratio above 1. 0 means operations generate enough cash to cover short-term obligations, signaling stronger financial resilience. The income statement and cash flow statement answer two different questions. The income statement shows revenue, expenses, and net profit over a period, and it can include non-cash items such as depreciation or accrued expenses. So, a business may appear profitable while still being short on cash. The cash flow statement tracks actual cash movement and shows whether the company can pay its bills now. The key is to use both together. Profit without cash flow is dangerous, while cash without profit is ultimately unsustainable. The key takeaway is that cash flow is your business's financial pulse. Start with operating cash flow, because it best reveals whether the core model works. Then distinguish operating, investing, and financing activities, and never confuse profit with cash. Timing differences can put a profitable business at risk.